Do you know the secret airlines used to fly high? JETS ETF explained. Hey everyone, welcome back to Chat ETF. Today, we're taking a deep dive into the JETS ETF, also known as the US Global JETS ETF. Have you ever wondered how to invest in the exciting world of airlines, airplane manufacturers, and even airports? Well, the JETS ETF might be your answer. But before you jump in, there's more to this ETF than meets the eye. We'll explore what the JETS ETF is, how it works, and whether it can actually help diversify your portfolio. Plus, we'll uncover some potential risks to consider and how JETS stacks up against similar options. Stick around, the exciting world of airline investing awaits. Question 1. What is JETS ETF? The US Global JETS ETF, ticker symbol JETS, is an exchange-traded fund, ETF, designed to provide investors with exposure to the global airline industry. Here's a breakdown of what JETS offers. Investment focus. JETS tracks the performance of the US Global JETS Index, JETSX. This index includes companies across various segments of the air travel industry. Airlines, American Airlines, Southwest Airlines, United Airlines, Delta Airlines, Major Holdings, and other passenger airlines around the world. Aircraft manufacturers, Boeing, Airbus, and other companies that design and build airplanes. Airports and related services, companies that manage airports, provide terminal services, and even some airline-related internet media and service companies. Question 2. What is the JETS ETF's primary investment objective? The primary investment objective of the JETS ETF is to track the performance, before fees and expenses, of the US Global JETS Index, JETSX. In simpler terms, JETS aims to mimic the performance of this benchmark index, which represents a basket of companies in the global airline industry. Here's a deeper dive into what this means. Passive management. JETS doesn't actively try to outperform the market by selecting individual stocks. Instead, it passively follows the composition and weighting of the JETSX index. This index holds a variety of companies across the air travel sector, including airlines, aircraft manufacturers, airport operators, and related service providers. Matching index performance. By holding these companies in similar proportions as the JETSX index, JETS aims to deliver returns that closely match the overall performance of the airline industry, minus the fund's expenses. Key takeaway: JETS prioritizes replicating the performance of the chosen index over actively selecting and managing individual stocks within the airline industry. Additional points. While JETS tracks the index, it's important to understand that it won't perfectly match the index performance due to factors like expense ratios and tracking differences. The success of JETS hinges on the overall health of the companies within the JETSX index and the airline industry as a whole. Question 3. Does the JETS ETF track a specific index? Yes, the JETS ETF absolutely tracks a specific index, the US Global JETS Index, JETSX. This index serves as the benchmark for the ETF's investment strategy. Here's a breakdown of this relationship. Index as blueprint. The JETSX index acts as a blueprint for the JETS ETF. The index defines which companies the ETF should invest in and in what proportions. Passive management approach. JETS employs a passive management strategy, meaning it doesn't actively pick and choose individual stocks. Instead, it strives to mirror the composition of the JETSX index. Performance benchmark. The performance of the JETS ETF is directly tied to the performance of the JETSX index, minus the JETS ETF's own expenses. Benefits of tracking an index. Diversification. The JETSX index holds a variety of companies across the airline industry, ensuring the ETF isn't solely reliant on the success of any single airline. Transparency. The composition and weighting of the JETSX index are publicly available, allowing investors to understand what drives the ETF's performance. Lower costs. Passively tracking an index generally leads to lower fees compared to actively managed funds. Understanding the index construction. It's important to note that the JETSX index uses a smart beta 2.0 strategy to select companies within the airline industry. This means the index doesn't simply weight companies by their market capitalization, size. Instead, it applies specific criteria to identify what it considers to be the most efficient airlines and incorporates diversification through exposure to aircraft manufacturers and airport operators. Question 4. How has the JETS ETF performed in different market conditions? The JETS ETF's performance is heavily influenced by the overall health of the airline industry, which can be cyclical and sensitive to various market conditions. Here's a breakdown of how JETS might perform in different scenarios. Bull market. Favorable environment. During a bull market characterized by broad economic growth and rising consumer confidence, the airline industry typically thrives. Increased travel demand leads to higher passenger volumes, ticket prices, and potentially, airline profits. JETS performance. In a bull market, JETS would likely experience positive returns as the holdings within the U.S. Global JETS Index, JETS, benefit from the upswing. Stock prices of airlines, aircraft manufacturers, and airport operators could all rise, contributing to the ETF's overall growth. Bear market. Challenging times. Bear markets with declining stock prices and economic contraction pose significant challenges for the airline industry. Consumers tend to cut back on discretionary spending, including travel, leading to a drop in passenger demand and potentially airline losses. JETS performance. During a bear market, JETS would likely experience negative returns as the companies within the JETS index struggle. Decreased travel demand could lead to declining stock prices for airlines, impacting the ETF's value. Aircraft manufacturers and airport operators might also be affected by reduced travel and investment in new planes or infrastructure. Economic downturn. Vulnerability. The airline industry is particularly vulnerable to economic downturns as travel becomes a less essential expense for many. Events like recessions or global crises can significantly disrupt travel patterns and airline operations. JETS performance. During an economic downturn, JETS would likely face significant pressure. Reduced economic activity and consumer spending would likely lead to declining passenger numbers and potentially airline bankruptcies. This could cause a significant decline in the value of the JETS ETF. Oil price fluctuations. Double-edged sword. Oil prices are a major expense for airlines. When oil prices rise, airlines face higher fuel costs, squeezing their profit margins. Conversely, lower oil prices can be beneficial for airlines. JETS performance. JETS can be impacted by oil price fluctuations. Rising oil prices could put pressure on the ETF's holdings, while lower oil prices could provide some relief. However, the overall health of the economy and travel demand would also play a significant role. Other factors. Geopolitical events. Geopolitical events like wars or natural disasters can disrupt travel patterns and airline operations, impacting the JETS ETF. Airline regulations. Changes in government regulations or airline safety incidents can also affect the industry and the JETS ETF. Question 5. What are the key risks associated with the JETS ETF's investment strategy? The JETS ETF's investment strategy carries several key risks that investors should carefully consider before investing. Here's a breakdown of the most significant ones. Concentration risk. Airline industry reliance. JETS is heavily concentrated in the airline industry. This means the ETF's performance is directly tied to the health of airlines, aircraft manufacturers, and airport operators. If the airline industry suffers, JETS will likely experience significant losses. Limited diversification. While JETS offers some diversification within the air travel sector, it lacks the broad diversification of a total stock market ETF. This concentration can magnify losses compared to a more spread-out investment. Economic sensitivity. Cyclical industry. The airline industry is cyclical, meaning its performance fluctuates with the overall economy. During economic downturns, travel demand drops, airlines lose money, and stock prices decline, impacting JETS negatively. Consumer discretionary spending. Travel is often considered a discretionary expense. When economic times are tough, consumers tend to cut back on discretionary spending, further reducing airline revenue and impacting JETS. Oil price volatility. Fuel costs. Oil is a major expense for airlines. When oil prices rise, airlines face higher fuel costs, which can significantly eat into their profits and potentially lead to losses. This can negatively impact the stocks within JETS and the overall ETF value. Geopolitical events. Travel disruptions, wars, natural disasters, or other geopolitical events can disrupt travel patterns and airline operations. Flight cancellations, airspace closures, and reduced travel demand can cause significant losses for airlines and the JETS ETF. Other risks. Competition. The airline industry faces intense competition, which can pressure profit margins. Airline regulations. Changes in government regulations or airline safety incidents can also affect the industry and the JETS ETF. Expense ratio. The JETS ETF has an expense ratio, which is a fee that reduces your overall returns. Mitigating the risks. Investment timeframe. JETS might be more suitable for long-term investors who can ride out market fluctuations. Portfolio diversification. Consider including JETS as part of a well-diversified portfolio to reduce overall risk. Monitor industry trends. Stay informed about economic conditions, oil prices, and geopolitical events that could impact the airline industry. Question 6. Does JETS ETF contribute to portfolio diversification? The JETS ETF can contribute to portfolio diversification, but it depends on what your portfolio already holds. Here's a breakdown of the pros and cons to consider. Potential benefits for diversification. New sector exposure. If your portfolio primarily focuses on other sectors like technology or finance, adding JETS introduces exposure to the airline industry. This can help diversify your holdings and potentially reduce the impact of a downturn in any single sector. Reduced correlation. The airline industry has a somewhat lower correlation to the overall stock market compared to some other sectors. This means that JETS might not move in perfect lockstep with the broader market, potentially offering some hedging benefits during market downturns. Limitations to diversification. Concentration risk. JETS is still heavily concentrated within the airline industry itself. While it offers some diversification within the air travel sector, airlines, manufacturers, airports, it lacks the broad diversification of a total stock market ETF. Economic sensitivity. The airline industry is cyclical and sensitive to economic conditions. If the economy weakens, JETS might decline alongside other sectors, limiting its effectiveness as a diversifier. Overall impact on diversification. Depends on existing portfolio. JETS can be a diversification tool if your portfolio lacks exposure to the airline industry or cyclical sectors. Maximizing diversification. For better diversification, consider JETS alongside assets with a lower correlation to the airline industry, such as bonds, commodities, or real estate ETFs. Question 7. Are there other ETFs with similar objectives of JETS ETF, but lower expense ratios? Yes, there are several ETFs with similar objectives to the JETS ETF, but potentially lower expense ratios. Here's a comparison to consider. Similarities. Industry focus. These ETFs primarily focus on companies within the global airline industry, including airlines, aircraft manufacturers, and airport operators. Investment objective. Their goal is to track the performance of an index that represents the airline industry, aiming to deliver returns similar to the overall sector. Lower expense ratio options. SPDR-SP Global Industrials ETF, XLI. This ETF offers broad exposure to the industrial sector, which includes airlines and aerospace companies alongside other industrial businesses. While not purely focused on airlines, it provides some diversification and has a lower expense ratio compared to JETS, around 0.10%. Invesco Aerospace Defense ETF, PBS. This ETF focuses on companies involved in aerospace and defense, with a significant allocation towards aerospace manufacturers like Boeing and Airbus. It also includes some airline holdings, but with a broader industry focus than JETS. The expense ratio of PBS is also lower than JETS, around 0.60%. Important considerations. Expense ratio comparison. While these ETFs might have lower expense ratios than JETS, currently 0.60%, it's crucial to compare the exact expense ratios as they can change slightly over time. Index composition. These ETFs track different indexes, so their holdings and performance might slightly differ from JETS due to the specific weighting of companies within the index. Research the specific index each ETF tracks to understand its composition. Diversification. For true diversification benefits, consider ETFs outside the airline industry altogether, such as total stock market ETFs or ETFs focused on different sectors or asset classes. Question 8. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, a combination of individual stocks or other ETFs could potentially achieve a similar outcome to the JETS ETF with lower costs or greater control. Here's a breakdown of the pros and cons to consider. Potentially lower costs. Expense ratios. By choosing individual stocks or other ETFs, you can avoid the expense ratio associated with the JETS ETF. While seemingly small, expense ratios can eat into your returns over time, especially for long-term investments. Greater control. Stock selection. Building your own basket of airline stocks allows you to pick specific companies you believe will outperform the broader industry. JETS tracks an index, so you have no control over the individual holdings. Industry weighting. You can adjust the weighting of different airline segments, e.g., budget airlines versus legacy carriers, within your portfolio, to reflect your investment thesis. JETS weights companies based on the index it tracks. Challenges and considerations. Research time. Selecting individual stocks requires significant research to understand each company's financials, competitive landscape, and future prospects. JETS provides instant diversification within the airline industry. Transaction costs. Buying and selling individual stocks incurs transaction fees, which can add up over time, especially for frequent trading. JETS avoids these fees as it trades like a single security. Portfolio management. Managing a portfolio of individual stocks requires ongoing monitoring and rebalancing to maintain your desired allocation. JETS offers a more passive approach. Diversification. While you can select multiple airline stocks, it might be difficult to achieve the same level of diversification within the industry compared to JETS. Expertise required. Successfully picking individual stocks and managing a portfolio requires a certain level of investment knowledge and experience. JETS offers a simpler, hands-off approach. Alternative ETFs. Instead of individual stocks, consider these ETF options for a potentially lower-cost alternative to JETS. Broad Industrials ETF, XLI, provides exposure to a broader industrial sector, including aerospace and airlines, with a lower expense ratio. Aerospace Defense ETF, PBS, focuses on aerospace and defense companies, with a significant allocation towards aerospace manufacturers and some airlines, also with a potentially lower expense ratio. Question 9. What are the pros and cons of this JETS ETF compared to similar options? Here's a breakdown of the pros and cons of the JETS ETF compared to similar options. JETS ETF Pros. Pure airline industry focus. JETS offers a concentrated play on the global airline industry, providing exposure to airlines, aircraft manufacturers, and airport operators. This can be appealing if you're bullish on the airline sector's future. Diversification within airlines. While JETS focuses on airlines, it offers some diversification within the air travel sector compared to simply buying airline stocks. This can help spread risk within the industry. Passive management and convenience. JETS tracks an index, offering a passive investment approach that requires minimal research or management. You buy one ETF and gain exposure to a basket of airline-related companies. Transparency. The holdings and weighting of the JETSX index are publicly available, allowing investors to understand what drives the ETF's performance. JETS ETF Cons. Higher expense ratio. Compared to some similar ETFs, JETS has a higher expense ratio, currently 60%. This fee reduces your overall returns. Concentration risk. JETS is heavily concentrated in the airline industry, making its performance highly dependent on the sector's health. If the airline industry struggles, JETS will likely experience significant losses. Limited diversification. JETS doesn't offer the same level of diversification as a total stock market ETF or even some broader sector ETFs. Economic sensitivity. The airline industry is cyclical and sensitive to economic conditions. During downturns, JETS could underperform compared to broader market investments. Similar options, pros. Lower expense ratios. Several ETFs like SPDR-SP Global Industrials ETF, XLI, or Invesco Aerospace Defense ETF, PBS, often have lower expense ratios than JETS. This can lead to potentially higher returns over time. Broader diversification. These ETFs might offer exposure to a broader sector, industrials, or focus on aerospace and defense with some airline holdings, PBS. This can provide diversification benefits and potentially reduce reliance solely on airlines. Similar options, cons. Less focused exposure. If you're specifically bullish on the airline industry, these ETFs might not offer the same concentrated exposure as JETS. Index composition. These ETFs track different indexes, so their holdings and performance might differ slightly from JETS due to the specific weighting of companies within the index. Question 10. What are the potential benefits and drawbacks of investing in JETS ETF compared to individual stocks within the same sector? Here's a breakdown of the potential benefits and drawbacks of investing in the JETS ETF compared to individual stocks within the airline industry. JETS ETF benefits. Diversification. JETS offers built-in diversification within the airline industry. It holds a basket of companies across airlines, aircraft manufacturers, and airport operators, reducing your reliance on the performance of any single company. Convenience and lower management time. JETS provides a one-stop shop for exposure to the airline sector. You don't need to research and pick individual stocks, saving you time and effort. Passive management. JETS follows a passive approach, tracking an index. This eliminates the need for active stock selection and analysis, potentially reducing investment risk for some investors. Transparency. The holdings and weighting of the JETS index are publicly available, allowing you to understand the ETF's underlying exposure. JETS ETF drawbacks. Higher expense ratio. JETS has an expense ratio, currently 60%, which reduces your overall returns compared to directly investing in stocks. These fees can eat into your profits, especially over the long term. Limited control. With JETS, you have no control over the specific companies you're invested in. The index determines the holdings and their weighting within the ETF. Concentration risk. JETS is heavily concentrated in the airline industry. The performance of the ETF is directly tied to the health of the airline sector. If the airline industry struggles, JETS will likely experience significant losses. Individual stocks benefits. Potentially lower costs. You avoid the expense ratio associated with JETS. By buying stocks directly, you keep more of your returns. Greater control. You can choose specific airline stocks you believe will outperform the broader industry. This allows you to potentially capture higher returns if your stock picks outperform the JETS index. Tailored portfolio. You can build a portfolio with specific airlines you favor based on factors like growth potential, dividend yield, or risk profile. Individual stocks drawbacks. Increased research time. Selecting individual stocks requires significant research to understand each company's financials, competitive landscape, and future prospects. This can be time-consuming and requires ongoing monitoring. Higher transaction costs. Buying and selling individual stocks incur transaction fees, which can add up over time, especially for frequent trading. Concentration risk. Investing in a limited number of stocks can be risky. If a company you hold performs poorly, it can significantly impact your overall portfolio compared to the diversification offered by JETS. Management expertise. Successfully picking individual stocks and managing a portfolio requires a certain level of investment knowledge and experience. Choosing the right approach. The best option depends on your investment goals and risk tolerance. Passive investor seeking diversification. If you prefer a hands-off approach and value diversification within the airline sector, JETS could be a good choice despite the expense ratio. Active investor with research skills. If you have the time and knowledge to research individual stocks and are comfortable managing a portfolio, you might achieve potentially higher returns by picking airline stocks. However, this approach comes with greater risk. Risk tolerance. Consider your risk tolerance. JETS offers built-in diversification, potentially reducing risk compared to individual stock picking. Alright folks, we've reached the end of our flight with the JETS ETF. So, to recap. 1. The JETS ETF tracks the U.S. Global JETS Index, giving you exposure to the airline industry in one shot. 2. It offers some diversification within airlines, manufacturers, airports, but not as much as a total stock market ETF. 3. While convenient, JETS comes with a higher expense ratio compared to some similar options. 4. Investing in individual airline stocks offers potentially lower costs and more control, but requires research and management time. Ultimately, the decision of whether JETS fits your portfolio depends on your goals and risk tolerance. If you want a simple, diversified play on airlines for the long term, JETS could be a good option. If you prioritize lower costs and are comfortable picking individual stocks, exploring other ETFs, or even building your own basket of airline holdings might be a better fit. No matter which route you choose, remember, diversification is key. Don't let your investments become a one-way ticket to turbulence. Thanks for joining us on Chat ETF today. If you enjoyed this video, don't forget to like and subscribe for more in-depth ETF discussions. We'll see you on the next flight.